The physical silver market is already pricing a shortage. The paper market is still pretending this is just another noisy pullback. That's the split you need to understand right now, because when the screen price and the real world price stop agreeing, it's not just a premium. It's the market telling you where the stress lives. And the stress is not where most people are looking. It's not in a headline. It's not in a tweet. It's in the plumbing, deliverable metal, in the right form, in the right place, at the exact moment someone actually needs to settle. And before we're done, I'm going to give you the simple scoreboard to track this week the few levels that matter on the chart, and the two scenarios that decide whether this turns into a controlled retest or a continuation move that gaps when nobody is ready. Because the move you're rewatching is an AT emotion. It guess math, forced through a tight pipe, and somebody's trying to sell you the story that nothing's happening. Now, here's the lockout that should bother you. I called 12 wholesalers and the conversations didn't feel like shopping. They felt like rationing. Not because every single ounce on earth vanished overnight, but because when supply gets tight at the wholesale layer, the first thing that disappears isn't silver itself. It's a clean, firm quote. It's the willingness to sell below a certain premium. It's the willingness to guarantee immediate delivery. You start hearing the same phrases: allocation, delayed ship dates, minimum lots, call back. We can't hold that price. We're not quoting that size. We're full. Inventory is in motion. We can do it, but not at that premium. And then the number shows up like a wall. None would sell below a 95 per ounce premium for immediate ready-to-ship product in the form people actually want. Let that land. A premium that big is not a normal dealer markup. That's not fabrication cost. That's not a tiny spread for convenience. That's a sign the wholesale layer is protecting itself from being cleaned out. Because if they sell too cheaply and they can't replace, they've just written a blank check against their own inventory. And that's where the real pressure starts. But you have to translate it properly or you'll miss what it implies. $95 premium is a phrase that can sound like internet drama if you don't do the math. So do the math. If spot silver is trading in the mid to high 70s, let us call it roughly $76 to $80, which is where it has been printing in early January, then a 95 premium means the all-in cash price for that real deliverable ounce is not 80. It is closer to 175. And if you are thinking, that can't be right, good, because that disbelief is exactly how markets keep people calm while the plumbing is breaking. Now, I'm not telling you every form of silver is trading at that extreme, everywhere, for everyone. I'm telling you the signal is that in certain forms, especially the forms that settle quickly, the forms retail investors can actually source, the forms fabricators can move, there's a lockout behavior at the wholesale layer. That behavior matters more than the loudest chart, because the chart is the visible story. The lockout is the hidden story. And the next detail is what flips the whole setup. Price context first, because we're not doing vibes. In the first days of January 2026, silver didn't just drift, it moved. It printed around the low 70s at the very start of the month, ran hard into the low 80s within the first week, then snapped back into the high 70s, then bounced again. That is not normal. That is a market with thin liquidity and crowded positioning, where a relatively small change in flow can shove price multiple dollars in a session. And you've heard the polite version of why? Volatility. Seemed, but here, as the less polite version, silver is trading like a market that is becoming regionalized, metal in one place, demand in another, and the bridge between them getting expensive. Goldman itself has been warning that the problem isn't necessarily a global shortage. It's that the metal can get stuck in the wrong places, and when London liquidity is thin, price swings get violent. That matters because London is a key reference point for global pricing and settlement. If the London pool is tight, the paper price can whip while physical quotes harden. And that whip is not random. It's the paper market discovering, in real time, how sensitive it has become to marginal demand. But that's not the part most people should focus on. The part that matters is why the paper market can look fine, while the physical market is screaming. And the answer is the hidden detail. The market doesn't T-run on how much silver exists. The market runs on how much is available to be delivered in the right form, in the right location, without delay. Total stock numbers can be huge and still functionally unavailable. Because a lot of metal is owned, earmarked, pledged, leased, tied up in ETF structures, sitting in long-term custody, sitting in industrial inventories that won't be released, or sitting in a region where moving it triggers costs, delays, and risk that nobody wants to take on short notice. You can have a warehouse full of silver and still have a market that feels empty if the free float is small. And that's exactly how tight markets behave. Headlines focus on total inventory. Professionals focus on deliverable inventory, and the spread between them becomes your tell. Because if this one pipe clogs, the math changes. Here's the mechanism, simple and brutal. Paper silver, futures, forwards, unallocated claims, can trade all day without a single bar moving. That's the design. It's efficient for hedging. It's efficient for risk transfer. It's efficient until it isn't. Physical silver, on the other hand, must obey reality. The bar has to exist. It has to be the right bar. It has to be assayed. It has to be in the right vault network. It has to clear. It has to ship. And it has to be turned into the product form somebody actually uses. That pipeline has friction. And friction is what creates premiums. When the pipeline is smooth, premiums shrink. When the pipeline is stressed, premiums expand. When the pipeline is at risk of snapping, wholesalers stop quoting like merchants and start quoting like risk managers. They widen, they delay, they ration, they lock out. That's not conspiracy, that's incentives. If you sell your last inventory at yesterday, S premium, and tomorrow, you can only replace it at triple the cost. Or you can T replace it at all. You just blew up your own business. So they do the only rational thing. They protect the book. And the market only has two ways to respond. Either the paper price rises enough to pull physical supply out of hiding, or physical demand collapses enough to relieve the pressure. Everything else is noise. Now, you're going to hear people argue, but London Vault holdings are huge. And yes, London Vault data shows tens of thousands of tons of silver held in London vaults. At the end of December 2025, London held around 27,618 tons, and it even ticked up month over month. So if you stop there, you'll say, no shortage. But again, deliverable is not the same as total. London Vault holdings are a custody statistic, not a for-sale statistic. A lot of that metal is owned by long-term holders, ETFs, institutions that have no interest in meeting sudden foreign demand, or entities that cannot or will not mobilize bars quickly. The free float, the metal that can actually be sourced on short notice without moving mountains, is what matters. And when the free float is small, the market becomes jumpy because the marginal ounce sets the price. That is why you can see a month where vault totals rise and still see a market that feels tight. Inventory can be growing in one pocket while deliverable supply is shrinking in another. It's not contradictory. It's fragmentation. And that's where the spread starts telling the truth. In a healthy market, the relationship between spot and futures, between 1 month and the next, between regions, behaves like gravity. It's not perfectly stable, but it's predictable. Carry costs, storage, financing, they set the slope. When that relationship starts to warp, when immediate delivery starts to trade rich relative to later delivery, or when the cost to borrow metal rises, you're watching tightness. You don't need a conspiracy board. You need to watch term structure and borrowing costs. In metals, lease rates are the quiet alarm, the cost of borrowing physical metal. When lease rates spike, it's often a sign the market is paying up for immediate access. That can happen for many reasons. Shorts needing metal, fabricators needing supply, vault stress, settlement needs. But the common thread is the same. Someone needs real metal now, not a promise later. And you'll notice something else. These signals tend to appear before retail headlines catch up. Retail sees premiums after the stress has already been building. That's why that $95 premium matters as a timing signal. It's the symptom that leaks out of the institutional layer and hits the street. And once the street sees it, you're already in the part of the movie where decisions get forced. Because now the game becomes a set of forced choices. Wholesalers are forced to protect inventory. Market makers are forced to widen spreads. Shorts are forced to manage margin. And participants who were comfortable rolling paper positions are suddenly forced to think about what happens if physical settlement becomes expensive. But the next detail is the one most people miss. Why this is happening now in this particular week with this particular violence. This is not just silver is volatile. This is a calendar trade colliding with thin liquidity. Early January is a window where positioning can shift fast. Funds rebalance desks, reset risk, some hedges roll, and liquidity can be deceptive because everyone thinks the year is fresh. But inventories and supply chains aren't a tea fresh at all. They carry last year as constraints into this year with flows. If the market is already tight, then any calendar-driven flow becomes a catalyst. And if liquidity is thinner than people think, especially in the physical lending and London settlement channels, then a small shove becomes a big swing. That's why you can go from low 70s to low 80s quickly, then snap back. Those are not organic, leisurely price discoveries. Those are mechanical moves hitting a fragile order book. And if you're watching this week, you have to respect weekend gap risk too. Tight markets hate weekends because time passes while liquidity is closed. If something changes in policy tone, if a geopolitical headline hits, if shipping constraints tighten, the reopening can gap. And the market will punish anyone who thought it can't move that much. Silver absolutely can. It already did. Now, let's talk about the specific wrong places problem because it connects directly to your lockout. A key theme that's been circulating is that a lot of metal has moved into U.S. vaults amid tariff concerns and policy uncertainty, and that even if clarity comes later, metal doesn't always flow back smoothly. Once bars move and custody arrangements change, the supply chain develops inertia. Participants who grabbed physical buffers don't rush to release them back into the global pool. They hoard them because uncertainty is sticky. That hoarding fragments liquidity further. It turns a global market into regional pools that don't share. And once you're in that regime, premiums don't behave like normal. They behave like insurance. They behave like the cost of certainty. And that is precisely what a $95 premium is saying. If you want certainty, pay up. But here is the part that can make this explode or deflate fast. Paper markets can turn on a dime when positioning is wrong. That's where options and reflexivity step in. This move isn't just about fundamentals. It's also about how dealers hedge options exposure. When options open interest stacks around key strikes and price approaches those levels, dealer hedging flows can amplify moves. If the market is in a zone where dealers are short gamma, then as price rises, they're forced to buy to hedge, which pushes price higher, which forces more buying. That's the reflexive loop. It's not mystical, it's mechanical. And it can turn a calm grind into a face-ripping squeeze in a thin market. The flip side is also true. If price drops through a key level in a negative gamma zone, hedging can accelerate the decline. That's why the chart levels matter, and why I am bullish long-term is not enough if you were trading the next 2 weeks. Because the next 2 weeks are about flow, not philosophy. And that's also why you can be right and still get hurt. Silver is notorious for punishing timing, even when the core thesis is correct. It will whip you, embarrass you, and try to make you quit right before it moves again. That's not drama. That's how leveraged markets transfer conviction from the impatient to the patient. And that brings us to the second forced choice, margin. In a fast move, shorts don't always exit because they change their minds. They exit because their broker changed the rules. If the market rises quickly, margin requirements bite. If liquidity is thin, stop orders cascade. If borrowing costs are rising, the cost to maintain a short grows. That's a recipe for forced covering. And forced covering doesn't care about your argument. It cares about survival. This is why a market can go from nobody believes it to everyone is chasing it in days. And if you want to spot the transition, don't look for the loudest influencer. Look for the quiet metrics. Term structure behavior, the cost of borrowing metal, delivery activity, and physical premiums that refuse to fall even after pullbacks. Because if the thesis is real, pullbacks won't fix the physical stress. They'll just change the paper mood. And that difference, paper mood versus physical stress, is where the trade lives. So let's stack proof, not just talk. Proof point 1, the street symptom. When wholesalers and large suppliers won't quote below a certain premium, they're effectively telling you replacement risk is high. That's not a marketing tactic. That's risk control. Proof point 2, price action itself. A move from the low 70s into the low 80s within the first week of the year, with sharp daily swings, is consistent with a market where small changes in flow move price. Proof point 3, delivery activity. The COMEX delivery reports in early January show meaningful delivery flow in the January 2026 contract, millions of ounces in notices in just the first week. That doesn't automatically mean shortage, but it does mean settlement and physical linked flows are active, and in a tight market that matters. Proof point 4, the location narrative from major institutions. The idea that metal is stuck in the wrong places, London liquidity is strained, and volatility is structurally higher. That aligns with a world where premiums harden because regional pools don't share. Proof point 5, vault totals versus free float. London holdings can rise while the market feels tight if the available portion is shrinking, because custody doesn't equal supply for sale. Proof point 6, ETFs and institutional flows. Even commentary suggesting physically backed ETF holdings are below prior peaks is important because it implies price can move without the obvious retail mania. That means the marginal buyer may be a mix of industrial procurement, institutional hedging, and short cover reflexivity. Exactly the kind of flow that creates sudden moves without warning. And here, as proof point 7, the one that ties to your title most directly, the premium itself becomes a market structure signal. Premiums are like spreads in a credit market. When spreads widen, it's not because everyone got emotional, it's because risk rose. That premium is the risk price of immediacy. Now, you might be thinking, okay, but can this just go away? Yes, and you need to respect that because credibility comes from seeing both sides. There are clean ways this pressure can release without a moonshot. If policy uncertainty clears and metal starts flowing back into the most liquid global pool, liquidity improves and premiums compress. If industrial demand slows, especially if manufacturing buyers delay procurement, pressure eases. If recycling supply increases meaningfully, the pipeline loosens. If fabricators catch up and lead times shorten, scarcity premiums fall. And sometimes, markets just overshoot on fear and then normalize. That can happen here too. But here is what can ET happen quietly. If the premium stays stubborn while price pulls back, that's not normalization. that stress staying alive under the surface. And that's what you have to watch this week, because the market will try to confuse you. It will drop price and flood your feed with, "See, it's over." Meanwhile, physical quotes won't budge, delivery tightness won't ease, and borrowing costs may remain elevated. That divergence is the trap. And that's where the viewer psychology shield matters, because the market uses volatility as a weapon. It doesn't need a villain. It doesn't need a conspiracy. It just needs human nature. Here's how you get played. First, the market runs hard and you feel late. You feel stupid for not being in. You chase, then it whips down, and you feel punished for chasing. You sell, then it stabilizes, and you feel relief. Then it runs again, and you feel anger. That emotional cycle is how liquidity gets harvested. The solution is not to become emotionless. The solution is to separate trend signals from noise. Trend signals in a tight market are things like premiums staying elevated, spreads staying stressed, deliverable supply staying constrained, and higher lows holding on the chart. Noise is the intraday spike, the scary headline, the red candle that exists purely because dealers had to rebalance. If you can't separate those, you're trading your nervous system, not the market. And in silver, trading your nervous system is expensive, so build rules. Position size so you can survive the whip. Expect violent moves, even if you're right. Decide in advance what would invalidate your thesis. And don't let a single day decide your entire identity. Because that's how volatility eats people. Now, let's get practical, because watching this like a grown-up means you need a near-term roadmap, not just a vibe. Think in two scenarios. Scenario one is the controlled pullback and retest. In this scenario, price chops, maybe revisits a support zone in the mid to high 70s, shakes out late longs, and then tries to hold. What confirms this scenario is stability. You see dips bought, you see premiums stop expanding, maybe even compress slightly, and you see spreads calm instead of scream. You might see the market stop printing huge intraday ranges. You might see the paper price and physical quotes begin to reconnect, even if slowly. That's the market digesting. It's not bearish, it's constructive. But the key is whether physical stress eases. If the physical premium collapses during a pullback, that tells you the tightness was more transient. If the premium stays elevated, that tells you the tightness is structural and the pullback may be a reset before the next push. Scenario two is the continuation squeeze and gap risk. In this scenario, the market doesn't give you a polite retest. It holds above key support, rolls higher, and once it clears a visible level, think the psychological low 80s area where sellers already showed up, dealers and shorts are forced into the move. If options positioning is dense above that zone, hedging flows can accelerate it. If liquidity is thin, it can gap. If it gaps, it will feel unfair. It will feel like it skipped your entry. That's what tight markets do. They deny comfort. What confirms this scenario is not just price going up. It's the accompanying signals. Premiums not easing, the physical market staying firm, and the market behaving like supply is being rationed. What weakens it is a sudden restoration of liquidity, premiums compressing fast, quotes coming back, wholesalers suddenly willing to sell at normal spreads. If that happens, the squeeze loses fuel. But until you see that, you have to respect continuation risk. And this is where the chart levels become your guardrails. I'm not going to pretend I have a magic number that guarantees anything. But there are common sense zones that matter because they're where human behavior clusters. The mid to high 70s has become a battlefield zone in this early January action. When price dips into that region, you watch whether buyers defend it. Above that, the low 80s is a visible pivot. Price has already proven it can reach it, and it has also proven sellers respond there. If the market can reclaim and hold above that pivot with force, it changes the psychology and it can change the hedging flows. Below the battlefield, if the market loses key support and physical premiums start collapsing at the same time, that is the kind of combined signal that says the stress is releasing and the paper market may take control again for a while. That doesn't mean thesis dead forever. It means this chapter is over, and you trade chapters, not marriages. Now, one more mechanism you need to have in your head, because it explains why premiums can become absurd even when spot is only in the 70s, supply chain lead times and form factors. Silver supply isn't a faucet you turn on. A lot of silver is a byproduct of mining other metals, which means its production responds slowly to price. Refining capacity has constraints. Fabrication capacity has constraints. And moving large bars into small retail products requires time, machinery, and scheduling. When demand spikes for a particular form, say immediate delivery in 1-ounce forms, those bottlenecks can create scarcity premiums that look ridiculous compared to spot. The spot market can be pricing the raw metal in bulk form somewhere in the system, while the consumer market is pricing the convenience and immediacy of a finished product. And wholesalers sit right at that junction. They feel the bottleneck first. They also feel credit risk first. Because when volatility explodes, credit lines matter, counterparties matter, risk managers matter. In a calm market, everyone is friendly. In a tight market, everyone asks, can I replace this inventory? Can I hedge this exposure? Can I trust settlement? What happens if this moves $5 overnight? And those questions widen premiums. That's why your 12 calls matter. They're not sentiment. They're a reading of risk appetite at the supply choke point. And when risk appetite disappears, price can move without warning. That's the setup. Now, let's address the skeptics directly, because your audience is full of them and they're right to be skeptical. The internet loves to scream shortage anytime premiums rise. The truth is more nuanced. You can have a market that is tight in specific channels without being globally depleted. You can have stress that is real and still temporary. You can have structural volatility without guaranteed upside. And you can have a screaming premium in retail forms while bulk bars remain more available. That's why the only sane approach is a scoreboard, not a slogan. Here's the scoreboard you track over the next week or two. 1. Does the physical premium remain elevated even on paper pullbacks? 2. Do wholesalers remain reluctant to quote aggressively, or do quotes normalize? 3. Do delivery-related headlines and reports show continued heavy settlement activity? 4. Does the narrative about metal in the wrong place persist, or do you see signs of metal flowing back into the most liquid pools? 5. Does price hold the key support zone on the chart, or does it break and stay broken? 6. Do options-driven moves feel like they're accelerating, or do they feel like they're fading? That's it. You don't need 10 indicators. You need the right 6. And then you protect yourself from the biggest trap, thinking you must act on every tick. You don't. The market wants you to feel like you're missing it. That urgency is how it gets you to pay the spread at the worst moment. In a market like this, patience is not passive. It's a position. And if you are the type of investor who S here because you don't trust institutions, because you don't like the idea that paper claims can distort reality, then this is the moment to be extra disciplined, not extra impulsive. Because the market loves to punish people who are emotionally right, but mechanically sloppy. Let Issus bring it home with the real takeaway. The 95 premium lockout is not the story, it's the flare. The story is the split between paper liquidity and physical scarcity signals, driven by location constraints, calendar-driven flows, and hedging mechanics that can amplify moves in either direction. The payoff is knowing what matters next, instead of arguing about what happened yesterday. So here's what matters next. If silver holds the battlefield zone and premiums refuse to compress, you should assume the pressure is still building under the surface, even if the chart looks choppy. If silver reclaims the pivot zone above recent highs with strength and the physical market stays tight, you should respect continuation risk because forced buying can kick in fast. If silver breaks down and premiums collapse at the same time, you should respect that the market is releasing pressure and that a deeper reset is possible. In all cases, expect violent whips, expect headline manipulation, expect your feed to flip from shortage to bubble in 48 hours. That's not information, that's emotional warfare. Your job is not to be the loudest. Your job is to be the calmest person in a volatile room. And if you're building a community of people who think that way, mechanics first, ego last, then you already know what to do. Track the scoreboard share, real-world quotes, compare notes on availability, and stay focused on what forces participants to act, not what makes them talk. Because when the market is rationing, talk is cheap. Metal isn't.